Now, right after we peaked in March, I told you to be watching the 20-week moving average. I've talked about this chart for weeks, even before we hit the 20-week moving average. I've been talking about this chart. You that we could bounce and bottom on the 20-week moving average. You reached it. I told you that again. I said it's possible that that is a bottom. Because I told you that the market was either going to begin to go down, take out the 20-week, or it was going to do this. It was going to go down, get a sell-off, like what we had over here. We sold off 6%. We rebounded back up. We sold off almost 6% here, rebounded back up. And I told you it could do this or get a lower high if we just filled the gap. In order to get a bigger, stronger decline immediately, we had to take up that 20-week moving average. I've talked about all this at great length and detail before and when we touched that 20-week and after we touched that 20-week. I've been talking about the gap fill or the higher high, and this chart right here. I've shown you this chart over and over again in nearly every single video, but at least several times a week. I've been showing you this chart before we ever reached the 20-week moving average, and I talked about this divergence or confirmation of a lower high if we only went back to fill the gap. When we hit the 20-week moving average, the Dow had 3 gaps, and it can go back and fill them all or fill some of them. The S&P a rebound to fill gap at 5,200 or even try to form this divergence, which we've talked about. The July peak, we had the lower high. In 2022, we had the higher high, just moved slightly above this level, which is likely what's going to happen here. And in 2020, again, we moved slightly above the previous peak and formed the divergence before the pandemic sell-off. This is what I continue to talk about. Again, people believe, okay, well, the correction's done now. We're going to just continue to rally now into 2027, and the bull market going to continue, soft landing out of the Fed, all of the other talking points that we continue to hear on social media. I've been talking about a possible topping process here, going back up into this trend line, and I've talked about it at great length and detail. We're not reaching it and getting the lower high at the gap fill just above it at the 5,200 area, just overthrowing it and then getting a lower high like we had here. But I thought one of those scenarios was going to take place. It bounced off of the 20-week moving average. If we didn't fill the gap immediately, we could still go back and test this level and then go back up and do it. These are the levels I've been talking about. This is the chart that I've been showing you over and over again, and nothing has changed. The same thing. Again, the S&P bounces off the 20-week moving average over and over. Sometimes it violates it, but it bounces off of the 20-week moving average, and it gets rejection at it, and sometimes overthrows it. You take it out, again, we can get a bigger dump, or what I think could happen is a reversal, and we have the Fed pause. The Fed pause will give us a topping process, and that's why I've talked about the lower high or the higher high at such great length and detail. I told you we could still go above 5,300, which is likely, which we're now doing if we get the divergence scenario that looks something like this or this. There's, again, probably still more upside. Pull back and do it and form a divergence on the 60-minute chart with the RSI. This is the level and the trend lines I'll show you in a moment. Weekly and the monthly that I'm looking at. I've talked about them at great length and detail. Well, the conventional wisdom is, oh, we're in this new bull market. This was the bear market. It's now over. People saying that told us that was never going to happen. They're saying, again, that we're going to be in a new bull market and that we're going to have a soft landing out of the Fed. Happy days are here again. Again, this is complacency. I warned of a lower high or a higher high scenario. I told you I still believe it is a topping process. It takes its time doing what it's going to do. And again, the topping process here in the run-up, when we got up here, it took its time. Over here, took its time. It took several weeks. Spilling over into months, November, December, on into January over here. Here we had March, April. Now we're into May. Again, likely a topping process here. Will complete a divergence on the RSI. Up closer, there are 2 trend lines here up close that I've been watching. Again, the upper channel line, which again is still directly overhead, still have more room to run there, as we've talked about at great length and detail. And then this trend line right here, I've been watching this trend line for a while, connecting the peak here in 2022 with the peak right here at our March high, and we're hitting that right here, right now. And that's this dotted red line. We're just slamming right into that and just slightly overthrowing it just a bit. My guess is we're going to hit this upper channel line. And whoops, my lower boundary moved on me there. Just adjusted this. Sometimes save on these trend lines and they slightly move on you. But this is where I think we're going. And again, we now have a 4-week winning streak after a 3-week losing streak. We're now moving to a new high. And again, this is what we've been watching for, is to see if a divergence would develop on the RSI was a top similar to what we had over here. So this trend line, we're hitting it. We're probably going to overthrow that level. And you have this upper boundary, which again gives us some other trend lines to be watching. The top here in 2007, if we connect it to the 2022 top, again, directly overhead is where we're seeing that trend line come into play here, very, very close to the upper channel line I just showed you up close on the weekly chart. So this is the trend line from the 2007 high, S&P 500. Again, stiff resistance there. And if I bring the monthly chart up, you can see that trend line I just showed you on the weekly chart. That's this trend line right here that we're going to be reaching. We've overthrown the one from 2000. The 2000 peak, we've overthrown it. This is the linear scaling. If we look at the log scaling, we haven't overthrown it, and we're about to hit it. The log scaling, the longer term charts, often you can see it better with log scaling what's going on. But this is the monthly chart. Again, I've talked about this multiple point negative divergence. Time we've had a divergence, it has produced a major sell-off here in 2018, 2020, 2022, and now we have another one here. But I told you, again, after the 20-week moving average, that we still may try to rebound back up and still may end up seeing a little divergence develop here in the most recent price action. That apparently is happening. It's not making the divergence go away. The divergence is going to give us the next bear market, and we're likely in a topping process. Because the market takes its time doing what it's going to do, and people go, oh, well, then there's nothing to worry about going forward, and we're going to just have this bull market that's going to go on to 2027, maybe 2028. And that is called complacency. These divergences are going to play out. And again, it was just like with this peak right here in 2022. You had a peak, you turned down, you went back up, you made a lower high. You're doing the same thing here, but with another lower high, a series of lower highs. Multiple point divergences produce reversals. Each divergence on this chart, if we just pull up the percentage levels, produced a significant sell-off. And again, weakest one was 17% back over here in 2015 on into 2016. But the divergence, multiple point divergence here, led to the bear market. 51%. Divergence here led to the bear market, 57%. And then, as I said, this one here, 17. And then over here, again, 20%. 2018. And then another divergence here, 35% with the pandemic sell-off in 2020, and then here in 2027, another one, 27.5%. And again, this one's going to be no different. You have multiple point divergences. That's likely going to give you a reversal rather than just a correction in the longer-term bear market. Again, this is the longest bull market in history. People say, oh, no, this was the bear market and it's over. That's not the bear market. Dropped more than 27%. So what? That was 35% over here. 2011, we dropped 21%. We dropped 20% in 2018. These were not bear markets. They were larger corrections in the longer-term bull market. The thing here to note is that if we do push up a little bit higher, and it looks like my trend line moved a little bit on me again, and I can lock it into place, but then when the chart moves over a frame, it's locked into place. Doesn't move with the chart. So sometimes they move. Sorry about that. Again, if we move up here, you're hitting the resistance. Now, even here on the linear scaling, here in the monthly time frame, we've overthrown this trend line, but we haven't overthrown the trend line from the 2000 top on the log scaling. Here we have done it with the linear. Now, if I bring up the log scaling with the monthly chart, you can see the trend line going back to the 2000 top. And again, we got a lower high there. Here we got a higher high. That's why I talked about, again, the S&P rebounding back up. It could have gotten a lower high at the gap fill or a higher high up at the channel line. I talked about that at great length of detail. But this trend line right here, if you connect it to our peak there in 2022, again, we are directly below that. This is the log scaling. This is the trend line that we hit when we had the 2022 top. And I talked about that on the monthly chart here and the weekly at great length of detail at that time. And again, we turned right off of that trend line of resistance. And now we have that peak and the peak back over here for log scaling. So I want to show you both log and linear. Again, we're overthrowing the trend line with the linear, but here we haven't reached it yet with the log, which again, log is long-term charts. I use both. You get good information, good trend lines with both. So again, I tend to use both. Most people don't. Most people either use one or the other. Sometimes use log with longer-term charts. So again, beautiful channel here, and again, some major resistance directly overhead. So again, I think that we could reach this upper channel line, and it's coming in very, very close to the trend lines I'm showing you, the longer term. But again, if we just overthrow this one right here, we take the angle a little bit different from this peak here, going back again to 2007 here. And again, this is a linear chart that is directly overhead. Monthly chart, once again, on the log scaling back to the 2000 peak. Again, this level directly overhead. And again, if we hit that upper channel line, we'll be running into these levels or coming very, very close to them. Trend line from 2007 with our linear scaling, the trend line here with our log scaling from 2000. Let's look at these trend lines because they are resistance levels. The S&P will likely peak and begin to turn with a Fed pivot or before the Fed pivot in all likelihood. And while the market was extremely hopeful of 7 cuts, we're probably going to at least get a cut or 2 in all likelihood before the year ends. The pivot, the cut, is going to be bearish. It will begin to cut for a reason because recession is coming, or begin to see the problems with the banks, which is coming. They have massive exposure to the commercial real estate sector, much bigger than what we saw during the financial crisis. Exposure directly and indirectly through loans and mortgage-backed securities going to happen. So the Fed may end up cutting sooner rather than later. We start seeing that crisis begin to unfold sooner rather than later. Some important resistance levels to be paying attention to. I told you again, I was expecting either the lower high scenario at 5,200, just above it, or the higher high scenario to go up and hit the upper channel. And these other levels I'm looking at here, some of these other trend lines I'm showing you. Please consider supporting the channel with the link directly below. That allows me to be able to provide you this information. Follow the link, it'll take you to a secured site. You can donate any amount you want, but please consider helping out. I don't have any sponsors, just a direct relationship with you. Sponsors, because I turn that stuff down because I don't want to sell you a bunch of stuff. Please consider helping out today. Thank you. Told you yesterday again, the 9 count was in play for today. Now again, 9 counts, sometimes they play out, sometimes they don't. It means we're either going to get an immediate trend extension, going to get a reversal, or a pullback. If we get a reversal or pullback, we can still go a little bit higher and then turn. Sometimes you see that happen. You get the count, it counts, and they don't play out. An immediate trend extension in whatever trend you're moving in, up or down. Here we got a 9 count showing price exhaustion. I talked about 2 weeks ago the back-to-back bullish candlesticks with the Fed and then the hammer that followed. You got the inverted hammer and the hammer. I was expecting more upside, at least the upper boundary of the channel. I told you if we exceeded that, we could fill this gap right here at 51.99, the 52 area, and hit our 78.6 Fibonacci. I told you if we exceeded that, we can go to the upper channel line in the weekly time frame, which I've talked about. Those are the levels that I've talked about. The upper channel line, the gap fill, and the channel of rising resistance that we've already moved above. Now we have this 9 count. We're getting a 13 in the weekly time frame. Just because you get a 9 count doesn't mean that's it. You can turn immediately, but again, we're likely still going to hit that upper boundary in all likelihood. No guarantee, but in all likelihood, we can go higher and reach that level before all is said and done, or pull back and reach it and then go one or the other. But that upper channel line is the level that I'm looking at because I was looking for either a gap fill for a lower high or to fill the upper boundary I should say tag the upper boundary of that channel in the weekly time frame that I've been talking so much about. 9 count here means price exhaustion. We could see a turn. We still have our 20 below the 50, so again, and you still got a boatload of gaps. Again, possible double top formation or more likely head and shoulders pattern could now be in play. Even if we go a little higher, again, that is very, very much in play. Head and shoulders pattern. Neckline now being down here at this level here. Guarantee the pattern plays out. Again, sometimes double tops. Again, the second peak overthrows and then you turn. But if we keep going, then it's more likely, again, towards that upper boundary of the channel, it's more likely a head and shoulders. You'd have to see a right shoulder develop or a double top with an overthrow here. Now, again, a bigger overthrow. I'll be watching. Do we get a doji? Do we get a narrow range body here in the next 3 days? Do we get a topping tail? Do we hit that upper boundary this week before the week ends? Count here on the S&P daily, 9 count on the Dow, and again, possible double top here on the Dow. Again, overthrowing our 78.6 Fibonacci. We've got a 9 count. Here we got a 9 count, went a little bit lower and then bottomed out. 13 count, a little bit higher and topped out. And possible double top or, again, head and shoulders in play. Dow is just below 40,000. Will likely reach the 40,000 level. The financial channels happen. The Dow will likely get a turn here. It is also near resistance. Down here, I talked about the Dow coming back and filling these gaps. It's now filled all three, and here we are up here, and the Dow is just below the 40,000 area. And another huge warning sign, the transports is not making a new high. The Dow is. Again, the Dow weekly chart will likely come up here to this upper channel line, reach this level, the bell at 40,000, complete the diversions on the RSI, and then begin to turn. Talking about these divergences on NASDAQ, on the S&P, and the Dow here. That's it for the Dow, but we're getting a 9 count on S&P, NASDAQ, and S&P in the daily. It was up over 1%. NASDAQ was up 1.5%, getting a 9 count today. Again, moving to new high. Again, I talked about this gap fill. I talked about getting above the 78.6 Fibonacci. The gap fill and the high over here were in play because we did get above that 78.6 Fibonacci. And again, I talked about the 9 count earlier this week. Mean a top, prices are getting tired. It could mean a reversal immediately. It can mean we go a little higher and then either get a pullback or reversal. Sometimes accounts do not play out, so keep that in mind. One thing we should keep in mind is that the S&P, well, it's getting the 9 count in the daily. It's getting a 13 count in the weekly time frame. It's completing that this week. Again, counts tell us when prices are getting tired. Here we got a 9 count. We went higher for 2 weeks, and then we've got the sell-off. You got an overthrow there. It was a correction. Here we had a 9 count. It gave us a pullback, followed by a trend extension. We got a 9-9 signal. We went a little bit higher. NASDAQ went sideways, really going above the 9 count. Couldn't clear it. Just had some intra-week pushes above it, barely above it. P fared a little better, went above it here, but then we still turned down and had the sell-off. The 9-9 gave us that. Now we have a 13. Slamming up into resistance levels, as I'll be talking about in this video. I've watched this video all the way through. I'm going to be showing you all the resistance levels, various trend lines, how they intersect directly overhead in many cases. As we're getting the rally, and I talked about the lower high or the higher high scenario, we're getting the 13 count. Go higher than 13. The 13 doesn't mean the peak is in. It means we could be getting close. When we peaked in 2022, we went higher by 1 week above the peak over here. I didn't draw that very straight, but higher by 1 week, and then we tested it the next week, and that was a reversal bar. Could see something similar to that. Divergence is complete on the RSIs in the weekly time frame. Well, I've shown you this chart over and over again. There's another chart that I've shown you quite a bit, but again, I don't talk about it as much as the divergence on the RSI weekly chart, but this is also the S&P weekly chart. And I've talked about the NAAIM exposure index. This is the active money manager exposure to the markets. And I talked about when we had the divergence back up here in March, I talked about this. I showed you this chart, and I've shown you it since then as well. I told you we could easily get a divergence here, a triple divergence, much like what we had at the 2022 top. Here, We had the peak here, we sold off, we had a rally in December, we sold off a little bit more, and then we went up and we went slightly higher. Look at that, we went slightly higher than the previous peak, and that's likely what's happening here. We're moving above this level, so we could peak out here either this week or next week. Very possible. You peaked out here, staying up at those levels. The 1 week, pulled off of them, and then tested them again the next week, and then we began that reversal. So again, we could see the same thing here if we go a little bit higher and hit the level that I'm looking at per channel. But look at what's happening. We have a reading here of 91.55 on the NAAIM exposure index. At the same level, or near the same level, just slightly above it, of the peak right here. See the little dotted red line I drew in right there? Okay, and then this is the extreme up here at that 100 level. The extreme up here gave us the July peak. Extreme here gave us a peak in December, but we went sideways and then continued the advance and formed massive divergences everywhere in the daily time frame. Extreme down here gave us the October 2023 low. The extreme down here gave us the October 2022 low. Down over here, this divergence right here gave us the June 2020. On the weekly chart with NASDAQ, I've talked about the upper boundary here that we could still remember how we went sideways for 7 weeks, and I showed you we still might try to reach it and then go down. That was possible. The triangle, we had a downward resolution of the triangle. We sold off 8%. We dropped below the 20-week moving average, got back above it, and now we're rebounding back up towards it. And I talked about, again, it's still possible. And now NASDAQ is looking to do that. This is the log scaling, makes a much better rising wedge pattern on it than the linear scaling does. But again, you can see pattern that I'm looking at. We had the negative divergence already on NASDAQ with the peak over here. And again, likely going to form a multiple point divergence. And again, this is the area that I'm looking at directly overhead. Or if we look at the linear scaling, that was a log, this is linear. If we look at the linear, the trend line here, again, coming in just directly overhead here. And we have the trend line right here, again, from the high in 2021. We're at that level right now, just like the S&P. So if we overthrow it, then you've got this trend line right here directly overhead. You have also here in the linear channel a possible channel. We don't have to reach the upper end of the channel. It's possible we do, but again, just some levels and trend lines I'm looking at. The S&P moved to a higher high January 2022 and then tested at the second week there, reversed it there for about a week and a day or two, and then it began the reversal process. NASDAQ was not able to make a new high. Here we are moving above the previous peak. There's a divergence over here that did give us the divergence on the RSI did give us the reversal and a sell-off of 37.5%. So we're forming a very similar divergence to what we had back over there. So the log and the linear scaling trend lines on both. This is the linear scaling on the NASDAQ monthly chart. And again, we've overthrown the trend line. It did move slightly on me, but we overthrew it previously in February, reversed off of it, back down below it in March. Now we're getting back above it. The log scaling might be a better fit, but still may end up with a topping tail with these linear these linear scalings. Still may end up working out if we get a topping tail before the month ends in May. At the same multiple diversions forming on the NASDAQ. But let me show you the log scaling here. This is a top, by the way, with a lower high. Here, we're seeing a higher high. This is like what Amazon did with the bursting of the tech bubble. NASDAQ got a lower high with the bursting of the tech bubble. Amazon and others got a higher high and looked very, very similar to this. This looks very similar to the Amazon chart in topping process with the tech bubble. And I didn't mention on the S&P, but you get these massive divergences forming on the monthly chart as well with the MACDs. In the monthly time frame, again, here you can see we slightly overthrew it, and then we turned down off of it. Here, the trend line, and then now we're overthrowing it again. If we get a topping tail, again, that trend line on the linear time frame still may still be in play, but let me show you the log. This massive divergence, by the way, on the RSI, we're making a lower high after the peak over here, which again is another huge red flag in the monthly time frame. But again, take a look. Directly overhead, we have on the monthly log scaling, we have this trend line going back to the 2000 top. So again, these trend lines on both the S&P 500 and the NASDAQ, they're directly overhead. I think they could be very, very much in play here and very well could mark a major topping process. And again, notice the large divergence here on the RSI. You can see it better here as we zoom out. Getting a divergence in the most recent price action, much like what we had one back over here at the 2021 top for NASDAQ. I wanted to take the time to show you these resistance levels because they're directly overhead. Most people walking the face of the planet never look at the weekly and monthly charts. Most people don't see that these trend lines are directly overhead. And trend lines can be powerful. Again, both NASDAQ and S&P turned off of trend lines. Look at this black trend line right here. We turned right off of it here, and later the S&P did in January, turned off of its trend line, and then it kind of expanded into this larger channel that I drew from the low of October 2022. And again, important trend lines. Bounced off of the parallel boundary connecting this point and this point. So, pretty interesting stuff. These longer term trend lines are directly overhead. Now just quickly, we got a wide range bar. We gapped higher. So again, another gap to be watching. Possible double top or head and shoulders in play at this point. Probably still more upside into the upper boundary of the channel. Over here, I told you we got this doji after filling the gap, and we formed a triangle. We talked about that on the 60-minute chart and the 5-minute chart. We kept bouncing off the 200 period in the 5-minute time frame in that level, and we broke out of that with the PPI data, and that continued to follow through today with the CPI data. I showed you the triangle on the 5-minute chart and the 60-minute chart, but the 60-minute chart, we had the breakout of that. You can see it on the 5-minute chart. We kept firming up the little black arrows. We firmed up at the 200 period here. The trend line with the blue arrows is where we firmed up at. The trend line here with the red, and we had a breakout with the PPI, and Powell reassuring the next move is not going to be a rate hike. We gapped higher. You always want to watch a gap. Is it a gap and go, a gap and fill, or a gap and trap? Here it was a gap and go, and we went on higher. And again, this move right here, the breakout, yesterday I talked about firming up on the 60-minute chart and the potential of a triple divergence indicators and the 60-minute time frame, and that is happening. We gapped higher and kept going. That allowed momentum to firm up, which I talked about yesterday, and we had the breakout of the triangle, and that has given us this gap and moving above that March high. We have now a potential multiple point divergence here, but we're getting a new high on the RSI in the 60-minute time frame. So again, we might see some kind of peak and then turn back and maybe still go higher into the resistance levels that I'm talking about in this video. Do something similar to what we did at the 2022 top. Again, could see a peak this week or next week, possibly, if the RSI divergence in the weekly time frame begins to complete and start the reversal process. And here I'll be watching what happens here with the next rollover, and do we get a divergence on the RSI? If we start to drop below the momentum line and the momentum cloud, then we can get some kind of pullback, maybe even fill the gap and still go higher. I think we're likely headed to that upper channel line as I've talked about in this video. The RSI is reaching a new extreme, so again, it might be that we end up forming a divergence, that you start to turn down at some point and come back up and form a divergence, or a confirmation of a lower high if we see a peak sooner rather than later this week or next week. With the rally, the MACD is forming a divergence while the RSI is not. It's moving to a new high. Signals have a divergence already. The RSI does not. Have to get a divergence, but it certainly can. The March peak did form a divergence. It went 3 points higher than the previous peak. The RSI did not. So it could be something like this, where we start to go lower, come back up, or even make a lower high. But again, I'm watching that upper boundary on the channel. No requirement that we leave or reach that level, upper boundary of the channel, but more than likely, I think we're going to reach it, gravitate towards it, and probably turn. And maybe we do that before the week ends. Per channel in the weekly time frame that I've been talking about. CPI on the RSI, and we got the CPI. Previous three reports came in hot. I talked about a possible sigh of relief rally, break out of the triangle on the S&P 500 before today. That's given us the rally. We had the consumer price index on a monthly basis come in slightly better, 0.3%. It was expected to come in at 0.4%. The core came right in line with expectations at 0.3% on a month-over-month basis. The year number came on the headline number for CPI came in right in line with expectations. 3.4 came right in line. Again, they've been having these misses the last 3 months. Yes, 3 months. So this came in right in line with expectations, and it's lower than the 3.5% from the previous month. The core year over year came in right in line with expectations, 3.6, and is lower than the 3.8 from the previous month's year-over-year number. Came in line with expectations, slightly better on the month-over-month, year-over-year, or the month-over-month headline number. But the market breathing a big sigh of relief. Things were to come in better than expected or come in even in line with expectations. But again, the inflation data is still showing that it's elevated, not at the 2% target level, 3.4 with the headline number 3.6. The core is what the Fed looks at, and again, came in at 0.3%. If you take 0.3%, that's an average for every single month of the year. It calculates 3.6%. So again, it's still getting elevated. It needs a recession to fix the inflation issue, and they're going to get it. P makes its way to this upper channel line in all likelihood, and the other trend lines I'm talking about in this video, again, likely forming a negative divergence here in the weekly time frame. There's probably still more upside on the S&P before the divergence is complete. As that happens on the S&P 500, dollar is sinking back towards the trend line. I've talked about this. I told you that, look, we hit the 20-week moving average on the S&P 3.5 weeks ago. I told you, going to get a rally because the dollar and the 10-year yield were pulling back. The extent of the rally will depend on how much they pull back. I talked about the upper boundary of a channel line. I talked about the gap filling on the S&P, and I told you if we get above that, then we can go hit the upper channel line on the weekly chart. So the dollar is either going to find a bottom here around the 200 and this trend line right here, and the S&P goes up a little bit more and tries to top out. The dollar breaks this level, and the 10-year and the trend line has moved back to horizontal support. They're both coming back and testing the longer-term moving averages, which have recently gotten a bullish cross of 50 above the 200. The dollar breaks this trend line, dropping below the 200 and then breaking it. Then the S&P can hover up near resistance levels I'm talking about in this video. This is going to drag out. But if we just hit this level and bottom out, like we did over here, I mean, we hit this level and we bottomed out, or here we began to move and break this level, downward trend, bounce here with the dollar in this area, then the S&P 500 could get an immediate pullback or reversal. But if the dollar, that's this trend line right here, again, a potential channel, okay, and the dollar broke the downward trend line, and I told you it broke that, and it broke overhead resistance. I said that we could back test the overhead, the horizontal support. It was overhead resistance, now it's horizontal support. We're breaching that, and we're coming towards this trend line right here. If that is taken out, then you have this trend line right here that intersects with the downward trend line, and that is major support right in that area, just directly below this level. So again, I told you this could back test. It seems to be doing that. So I'm watching the trend line here. That was a trend line on the daily chart with the channel. I'm watching the trend lines here in the weekly time frame and our 20-week moving average, which we're coming back and testing right now. The dollar and the 10-year yield, they're pulling back. Inflation data this week, that's allowing the S&P to go up and make a new high, and we've talked about this at great length and detail. The 10-year yield, it broke the trend line. It's come back to horizontal support and our 200-period moving average for a test. As the 10 years dropping, we're getting the S&P rebounding. Now it's making a new all-time high. Earlier in the week, we had the VIX break out of the bullish falling wedge here, and we're getting a throwback to fill that gap right now. So I'm going to be watching what happens with the VIX. Abilities to return on the S&P 500. You got to get the VIX back above the 50-period moving average Told you when the S&P reached the 20-week moving average, we had hit this trend line here on the VIX, this dotted red line right here, and I told you a chance that we have a bottom in at the 20-week moving average. I've talked about it at great length and detail, doing again in this video as well. I talked about this chart, I talked about the 20-week moving average, and possibly the MACD rolling back over with that rejection at this trend line and the bounce off of the trend line that I drew, S&P 500 channel line, and bouncing off the 20-week moving average. So as we approach the upper channel line on the S&P 500, levels of resistance that we're at right now and longer-term resistance, pay attention to the VIX. Does it try to get some kind of rebound?